Hello and welcome to Portfolio Matters, week 115. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What have we got this week, Keith?
I'll put it in. Before we get going, quick reminder that Rogue Trader and I will be doing another live chat on the Discord this coming Tuesday. I hope you can join us. Okay, the news this week. Well, the big news was that we had GDP numbers for quarter one in the US, and they were disappointing. Growth came in at 1.1%, but inflation was persistent, and core PCE inflation actually rose to 4.9%. So in the US in Q1, we had stagflation. Joe Biden announced his re-election bid. He is 80 years old. And in the Eurozone, the Belgian central bank governor, who is a member of the rate setting committee, has warned that the ECB will continue raising rates until wage growth slows. So, reminder, the Bank of England and the Fed meet next week, and they're both expected to raise rates by 25 basis points. The other big news of the week was First Republic Bank. Now, in the US, we've had quarterly earnings. First Republic Bank reported that it had lost $100 billion worth of deposits last month, and its share price has fallen sharply. We will take you through this, but basically, it has lost deposits on which it's paying interest of 0.5%, and instead it's taken money from the Fed at the best part of 5%, and that has totally destroyed its profitability. It will not be able to survive as an independent entity. It needs to be sold. First Republic currently has equity of 18 billion, but the losses on its mortgage and loan book, if marked to market, would be 27 billion, i.e., it would have negative equity. It can't survive. And this is the share price, which is down 95%. And how does a company lose 95%? It loses 90% and then halves. And that's precisely what happened this week. And this is the regional bank ETF. And you'll see, although the big banks are doing well, the small regional banks are not doing well. As we talked about many times in the last few weeks, this is an underlying crisis which will grind away in the background. Now, something odd is happening in bond markets in the US. So the yield on US 1-month Treasury bills is 1.8% below 3-month. So somebody is paying up for good quality collateral. And if you look at the yield on 1-month T-bills below Fed funds, you'll see people are willing to pay 1.15% more than they can get from the Fed for good quality collateral. Now, thank you to Wayne J on our Discord, who I think has explained this. And I think what's happening is that financial entities are worried about their counterparties. And if you enter into a swap arrangement with an investment bank or another bank, if you give them cash as collateral, then that cash goes into the general pot in the bank. And if the bank goes bust, you become a creditor, and there is some uncertainty about whether you get the money back. If, however, you give them collateral in the form of a bond, that bond remains your property. And so if the bank goes bust, you retain title over the bond. And so what this shows is that financial entities are paying up for good quality collateral because they are scared of the solvency of their counterparties, we believe. But it could also be connected to fears of US default. So this is CDS on 5-year US bonds, and the cost of insuring them is higher than in developed markets, and 1 year is going parabolic. So markets are worried about a US default. Reminder, this is quite a small market though, so is that really representative? And the other thing that's happening is that China does not appear to be doing as well as expected. And later on, we will take you through the industrial commodity prices this week, and they all fell sharply. The market is concerned that Chinese reopening is not going as well as they anticipated. And meanwhile, in the UK, in our fully functioning state, that is the number of strike days lost, more than in the 1970s. Okay, and on that cheery note, into this week's economic data. So we had the PMIs for the UK, EU, and the US this week, and they're actually out last Friday. And they all paint a picture of a manufacturing sector which is not doing so well, but services sector which is firing on all cylinders and actually looks pretty good. UK manufacturing PMI came in at 46.6, down on expectations and worse than March, but the services came in at 54.9, which is a good figure, well beating expectations by a decent margin and well up on March. So overall, the composite was 53.9, decent expansion territory. Good news is the UK public sector borrowing requirement missed expectations and came in less than expected at only 20.7 billion. In the Eurozone, the manufacturing PMI for April was pretty awful, actually. 45.5, big miss on expectations. But the services came in at an enormous 56.6. That is hot, beating expectations and well up on March. So overall, the Eurozone economy is doing quite well, frankly. Good news in the Eurozone was that the Eurostat consumer surveys showed that inflation expectations were falling. That's good news. And also that firms were not expecting to raise their prices going forwards. Industrial sentiment fell sharply and looks poor, but services sentiment looks very good. And moving to the US, the manufacturing PMI has actually bounced a bit. So surprising. The US manufacturing sector, according to the S&P Global Manufacturing PMI, is actually back in expansion territory. We will show you some contradictory data in a bit. The service PMI rose sharply to 53.7, up on March, massively beating expectations. So overall, according to the PMIs, the US economy is doing quite well. Building permits, however, in March fell sharply from February, down 7.7% month on month. New home sales rose sharply in March, up 9.6% month on month, but pending home sales fell sharply. So lots of contradictory data. We know there's been a bounce in home sales, but the pending home sales suggest that will fade in the coming months, as you would expect, because of very poor home affordability and very high mortgage rates. And finally, onto the quarterly data. So the Q1 GDP annualized missed expectations by a decent margin. It was expected at 2, it only came in at 1.1. What is very disappointing is that inflation massively beat expectations. So PCE inflation came in at 4.2%. The consensus number just looks wrong, so ignore that. But what's important is that it rose to 4.2% from 3.7% in Q4 last year, and core again beat expectations and rose sharply from Q4. So all the indications are that in Q1, the Fed was failing to bring inflation under control. Richard, some charts.
Thank you, Keith. UK global manufacturing PMI hovering below 50, and UK global services PMI climbing above 50. And the composite just mid-50s, moving up.
Yeah, that looks absolutely fine, frankly.
Yeah. So the UK public sector net borrowing, well, doesn't really look absolutely fine. It looks pretty dreadful.
It does.
CPI industrial orders UK is looking pretty sick, as is the CBI, but that's another matter.
Yes.
The EU HCOB manufacturing PMI.
Yeah, I think that the S&P Global must have sold this or something, because it used to be the S&P Global manufacturing PMI. But anyway. And
then, so the manufacturing PMI is falling, the HCOB services PMI is rising, and the composite is somewhere in the middle.
Yeah, looking actually pretty good.
Yeah, strong services, weak manufacturing. As I say here, EU services sector performing much better than the manufacturing sector. The EU economic sentiment is just around about 100. EU consumer inflation expectations continuing to fall, although possibly, it's hard to tell, possibly not as quickly as they were, but definitely continuing quite a steep downtrend. And EU selling price expectations following pretty much the same path.
Yeah, that is very good news.
Yeah. The EU industrial sentiment just fallen below zero, is consistent with the previous data we've seen. EU services sentiment well above zero and looking quite healthy.
Yeah.
So the US GDP growth quarter on quarter, still just about there, hanging on by its fingernails. And US quarter on GDP contributions to real quarterly GDP growth. So the fall in inventories is quite substantial. In fact, it's the biggest contributor. So destocking going on there. Or you could put it that GDP was strong except for business investment, which was poor.
Yeah. The commentary is that, we reported this at the time, that consumer spending was extremely strong in January, which may have been the result of unseasonably warm weather and also of these one-off increases in social security spending in the US. So that's likely to fade in the coming months.
So consumer spending helped out by good weather in January, and government spending is growing at an unsustainable pace. And even if they raise the debt ceiling, the rate of growth of government spending is enormous. Yeah,
that's just, given the constraints you would expect on US government spending, because they can't issue more debt, you would have thought they would have been, reining back their expenditure to try and last as long as they can. But they're not.
No, Biden's policy is to spend as much money as possible, isn't it? I mean, that's a very unnuanced way of looking at it, but he has got these bills like the Inflation Reduction Act, and so huge expenditure. US real consumer spending quarter on quarter is actually pretty healthy, 3.7%, and US core PCE prices 4.9%. Been stuck at high fours, low fives, really, since for the last 10 months, hasn't it? Actually, 10 quarters, mate. Really? Last 10 quarters, yeah. Which means, which suggests rather that this is becoming an embedded rate of inflation for the PCE prices. Well,
what it shows is the US, the Fed needs to raise interest rates to get inflation under control. It is failing currently.
And PCE prices quarter on quarter annualized. So 4.2%, but we've got basically that's been the same. That's now stuck for a year. So the US manufacturing PMI looking quite healthy over the last couple of months.
Okay. Yes, but we're going to show you some charts in a bit from the US individual Feds of their manufacturing surveys, and they totally contradict this. So we just, we've got lots of contradictory data.
Yeah. US services PMI again looking quite healthy. And US services firms are starting to raise prices again, which is, of course, bad news for the Fed in their fight against inflation. And there's the US composite PMI, which is
looking
quite
very healthy.
There's the US Fed manufacturing index that Keith obliquely referred to a minute ago, -20, where it's been for best part of a year, I would say.
But also deteriorating, Richard. So This is Dallas Fed.
Yeah. US building permits, sort of just a bit below that 2010 to 2020 trend now. And month on month, quite a big drop month on month. Wait and see whether that persists.
Well, if the drop in bank lending we are forecasting occurs, then developers are going to find it very difficult to get loans to start new buildings. So we're expecting this to drop sharply.
Yeah. And there's the case should a house price index year on year. Notice it's dropped sharply to no change. And month on month, a slight uptick.
Yeah, that's February though, when actually mortgages fell in February and they've since risen again.
US new home sales back to the sort of 2017, 2018, 2019 average level.
Yeah, astonishing resilient.
Yeah. And month on month new home sales, quite a volatile series this, but nearly 10% this month. Pending home sales year on year doesn't look very healthy, as neither does the month on month figure. So here we have US Richmond Fed Services Index, which looks unhealthy and is
exactly fast. Yeah, so we're getting the service PMI saying everything's going hunky-dory, but then the individual Fed surveys from around the country are showing a very different picture.
Yeah. And the manufacturing index is actually more healthy than the Richmond Fed manufacturing index. It's actually more healthy than their services index.
Yeah.
Although it's not very healthy. And the Dallas Fed Services Index, not very well. Kansas Fed Manufacturing Index, decidedly unwell.
But also, in April, it fell off a cliff. And we've just had the S&P Global Services, so manufacturing PMI. So it shows things are improving. There's so much contradictory data.
Yeah. Durable goods orders in the US month on month, looking quite healthy.
Yeah, that was mainly aircraft, actually.
Right. And Redbook retail sales on a fairly steady downward trend. No change to that trend at the moment. Initial jobless claims, they've gone up since 2022, but they haven't gone up very much, and they seem fairly stable at slightly more. Continuing jobless claims, possibly still on an upward trend, possibly not, possibly rolling over. And the 30-year mortgage rate in the US is pretty steady, really, between 6 and 7% for the last 6 months. The mortgage market index appears to have stabilized.
Yeah, pretty much nothing going on.
Yeah. So US Q1 GDP was disappointing at 1.1% annualized. There's strong consumer spending in January, increased government spending, and both of which quite likely to fade in the coming months. So US core inflation quarter one was 4.9%, which the Fed will not want to hear. And in Q1, the US was in stagflation, which the Fed don't want to hear either. So the S&P Global PMI data for April showed strengthening economies on both sides of the Atlantic, with the services sector expanding at normal rates, but the manufacturing sector looking not so healthy. But the individual data, as we saw, was actually quite contradictory. And we're still watching the building market very carefully to see further signs of weakening. And at the moment, the only one we've got really is this recent drop in building permits.
Yeah, which, leads actual activity by 6 months. So
yeah. So we do appear to have some, is it persistently transient?
I think transitory, persistently transitory, Richard.
Sorry, persistently transitory.
You should be applying for a spot on the MPC, on the Fed, rate setting committee.
So we have persistently transitory inflation. So we have persistent transitory inflation, and the Fed is likely to raise interest rates next week, we think.
Yeah, basically, they haven't got inflation under control. And you have been saying for a while that we'll have stagflation. And I have been saying we can't have stagflation because the Fed will raise rates until they kill the economy and bring inflation under control. Now, let's see if they are actually willing to do that.
That is the question, Keith. And time will tell.
Okay, on to our least wanted section, errors and corrections. And this is embarrassing. So last week, I said Fergal Sharkey is the new chairman of Ofwat. And actually, that turns out to be an April Fool's gag that I very much fell for. So
well, I was slightly surprised when you said that, Keith, but I didn't know enough about the subject to challenge you.
Well, yeah. Beware what you read on Twitter. So anyway, thank you to our viewer RS for the win for pointing that out. Now, last week we did an important section on the credit impulse. And a quick reminder, credit impulse is not the change in credit. It is the change in the change in credit. It's the second derivative of credit. And it is a determinant of GDP growth. This is quite an important concept. I will be redoing this section as a separate podcast this weekend, just to get things entirely clear. And in writing down the formula, I put in an extra bracket. So the correct formula is there. And also, I didn't tell you what C was. And C is the stock of credit. Thank you to Mr. C. Peckham for writing in and correcting me. And reminder, the credit impulse is really important. So the black line is credit impulse and the blue line is real GDP. Credit impulse is a good forecaster of real GDP. And it's also a good forecaster of equity market returns, because obviously equity market returns are determined by corporate earnings, which are a function of GDP growth. And we know that banks have been tightening credit for a long time now, and that should mean that lending falls over the coming months. And we also know that in the US, the banking sector is only part of credit creation. And in Q1, bond issuance fell sharply. Now, a lot of outstanding bonds are going to need to be refinanced, and they will be refinanced at much higher yields. Now, it's quite rational for existing debtors to try and keep hold of their low interest debts for as long as possible before refinancing them. So some of that may be quite rational, rather than credit markets being closed. But at some stage, they're going to need to reopen to refinance a lot of low interest debt. So what I got wrong. Now, I gave you last week this very simple model to illustrate how the credit impulse works. So reminder, this is a model in which there is only one sector. There is the private sector whose income is 100. And in year naught, they spend 100. And spending equals GDP. So GDP is 100. In year two, their income is 100. They repay £10 worth of borrowing. So their spending falls to 90. And that means the credit impulse is strongly negative, and GDP growth, i.e. spending, is also strongly negative. Now, the point of this example was that in year 3, borrowing also falls, so the consumers continue to repay debts, but because they've reduced the speed at which they're repaying debts, their spending actually rises from 90 to 95. So the credit impulse is positive, and GDP has grown despite the fact credit flows remain negative. So the credit flow has halved from -10 to -5, but that results in an increase in GDP. So that was the point of the example. However, Mr. C. Peckham wrote in to correct me and point out, and this is a very interesting point, that this doesn't work because in any economy, income equals expenditure. So if the private sector tries to repay debt and cuts its spending to 90, that 90 is somebody else's income. So actually, income would fall to 90. This doesn't work. And so in order for the private sector to maintain its income of 100 while cutting debts, an extra sector is needed. Either government or the external, i.e. the export sector, is needed to increase its demand and buy the goods and services the private sector is cutting down on to maintain income in line with the GDP formula. So if we update this table, we now need to add an extra column. In this case, I've added exports. So when the private sector cuts borrowing, it needs to increase its exports to compensate for the drop in its demand so that its income can be maintained at 100. So the wider point is nominal deleveraging is impossible without inducing a fall in GDP unless another sector increases its spending. That's if all else is equal. So it is possible to deleverage if you have an offsetting increase in productivity, hours worked, or the velocity of money, all of which are theoretical. In reality, that doesn't really happen. And deleveraging is very difficult. And deleveraging is particularly difficult in countries that run an external deficit, such as the US or the UK, because that means if they don't increase their exports, then the government must increase its borrowing to allow the private sector to deleverage. And pause and take a look. This is the formal way of proving this in economics. So GDP can also be defined as savings plus consumption plus taxation. And pause, take a look. Bottom line is private sector balance equals the government sector balance and the external balance. If the private sector wants to increase its savings, then either the government must increase its deficit or exports must increase. If not, this equation doesn't balance. Reminder, it only works at a constant GDP. If the private sector is trying to increase its savings more than the government is increasing its deficit or exports are increasing, then you fall into a fallacy of composition and GDP will fall until everything comes back into balance. And finally, this is from China. The credit impulse is weak there as well. Richard, was that clear?
Quite complicated, isn't it, Keith? I think, yes, I think the way I like to look at it, assuming I've understood it correctly, is in a simplistic sense, is that if you borrow now, you're bringing forward future GDP.
Yeah.
And when you repay your debt, if you repay more debt than is being borrowed, i.e. the total amount of debt in the economy is shrinking, you're paying back the GDP that you brought forward. And by consequence, your current GDP has to fall unless you're exporting a lot.
Yes, that's right.
And of course, the other thing I would do in that is I would say I wouldn't differentiate between private sector debt and public sector debt. And so which leads me to the point of view, as we live in over indebted economies, if we're going to get rid of the over indebtedness, we have to have a reduction of real GDP.
Bottom line is, in order to cut the debt, you then either have to have recession or inflation. You're right. But we're not going to have recession. Therefore, it's inflation.
That's what I think. These things are all very approximate. The timeframes are impossible to determine, etc., etc. But fundamentally, that's my view.
Or interest rates just trend down to zero, which makes the debt sustainable. Okay, onto one chart. And talking about the US fiscal balance and the debt ceiling, I found this absolutely frightening. This is US government income and outlays for the first 6 months of this fiscal year. And total receipts, 2 trillion, outlays 3.1. So it is spending over 50% more than it takes in tax revenues. It's irresponsible. I mean, totally unsustainable. And the trajectory of US debt is, going parabolic. Something does need to be done. Now, part of this is due to the Trump tax cuts, which are due to expire, I think, in 2026. But I expect the Republicans to be trying to impose some fiscal discipline on the Biden administration. And I think the debt ceiling negotiations are going to be difficult.
I think you're right, Keith. I think they're going to be a mess.
Okay, and on that front, a quick piece about the debt ceiling, Richard.
Thank you, Keith. Does anyone know where the term ceiling comes from? Well, I'm going to tell you. It comes from wooden ships. So wooden ships have to have the gaps between their planks sealed. Hence the term ceiling for the sides, actually, and the top of when you're inside a boat, the deck from underneath. So here we have, as Keith pointed out, basically an exponentially increasing curve showing the US debt since 1980, and it rose very fast under Trump, and it's rising very fast under Biden. But basically, the economy isn't growing at this rate. The economy is not growing anything like this rate. So at some point, this mountain of debt collapses if it's not dealt with. And I think it has to be dealt with quite quickly. I don't think they're very far off it being completely unsustainable. Who knows? So fiscal year 2023 tax receipts are well down on last year. The disappointing tax receipts could bring forward the drop dead date. Now, I did read after we did last week's weekly, I did read that tax receipts were more than expected, and that moves the date back to mid-July.
Yes, I believe that's the case.
So we have these debt ceiling tussles where the two political parties fight it out. And it looks like we're setting up for a big fight here. So the government, whilst the fight is in progress, the government will spend from the TGA account, and that pushes liquidity into the system. And then they refill the TGA account once they've reached agreement, which removes the liquidity. And the Treasury cash balances in, I would call that dirty brown, but I'm sure other people call it red, Treasury cash balances are actually currently pretty low comparatively. So in 2011, when Obama had the tricky negotiations with the Republicans, the agreement between the two parties eventually reached involved $2 trillion of budget cuts. And Standard & Poor's downgraded the US credit rating from AAA to AA+. The S&P 500 fell, and the US economy stalled while the Fed instigated Operation Twist to try and bring down long-term interest rates. I was under Mr. Bernanke, or Dr. Bernanke, whatever it is. So I think it's going to get fairly nasty. I think if the Republicans try and take $2 trillion off the Biden expenditure plans, it's going to be a dirty fight.
Yeah, well, their initial bid, as we discussed last week, was for 4.5 trillion of cuts.
And this is a chart that shows the resolution of the debt ceiling negotiations is bad for equities. And well, it may be or it may not be, but I guess if it's resolved in a manner that the equity markets aren't expecting, then there will be a reaction.
Well, the point is that, the moment the debt ceiling negotiations are finalized, then suddenly the Treasury needs to refill the TGA, so it issues loads of bonds. And that sucks liquidity out of the system.
Yeah, yes, I guess so. I mean, it's like, if you're a short-term trader, as opposed to a conviction trader.
True.
I would say, well, the consequences of debt default, have a little look through that, and you can see that really, depending on your point of view, there are all sorts of different consequences of a debt default. None of them are good. And which is what ultimately will cause the two sides to reach an agreement.
So we've got some charts now just showing what the expected impact of a technical and an actual default would be. Now, a technical default is when the government can't pay for a period because it doesn't have the cash, but repays at some stage. So if a bill was coming due on, say, the 31st of May, then, and it wasn't redeemed, the interest was paid, but it was rolled over, say, into a new instrument, that would be a technical default. So that would raise uncertainty, and the forecast is that would lead to a rise in unemployment. You see here, starting actually mainly in 2024. An actual default would be absolutely catastrophic. And the forecast is that it would raise unemployment to over 12%. And you would have the financial system in the US would be toast. And this is the effect on GDP. And you'll see these are big numbers. An actual default is expected to lead to a drop in GDP of over 10%. And medium term, it could be expected to lead to inflation as people lost confidence in the financial system, and the velocity of money goes through the roof as people actually lose trust in holding money in their banks, or they prefer to actually spend it and have real goods.
So from 15th of April, tax receipts should start to refill the TGA, and I think they have. So the US government very dependent on these tax receipts. But as the TGA is filled up with tax receipts, so liquidity falls. And we know what happens when liquidity falls, the stock market falls.
Exactly. Although the S&P 500 had a very good day yesterday. So, correlation is not perfect.
And this is a little chart showing a large meteorite about to crash into Earth, but it's okay because it's priced in.
Exactly.
What is a standard? Is that a 5 standard deviation event, Keith?
I think it's less than that, Richard.
It says something about the measurement of standard deviation in financial markets, doesn't it?
Mm.
It's precisely inaccurate.
Yes, good way of putting it.
So we haven't started the debt ceiling negotiations yet. They're likely to be fraught. The current government deficit is completely unsustainable. And the Republican Party is likely to demand some expenditure reduction measures to secure an agreement. Negotiations will be tough. I think they will be successful because political turkeys rarely vote for Christmas. So we'll keep you updated. And there's a bit more breathing space than we thought there might have been last week.
Yeah.
Sometime mid-July. So Keith, we're moving on to Financial Crisis Watch.
Yeah. And actually, this is going to be very brief because we're really waiting data out today. So the St. Louis Fed, where I get all this data from, announces the bank deposit data on a Friday, but with a 1-week lag. So later today, we'll get the data that shows the outflows from the banking system to pay taxes. And we're expecting that to be substantial. So watch this space next week. But so this is data the 12th of April. And even before the tax date, bank deposits were falling. That's for large banks, for small banks. And a reminder, we're expecting big drops in this week's data. So 100 billion is expected to flow from the banking system into the TGA account. And this is loans and leases. And you see that there was a drop in bank lending before the 12th of April. Now, the fall in deposits is not going to incentivize further lending. And when you look at that drop in lending in the 4 weeks of the 12th of April, that is quite a substantial drop. Reminder, the credit impulse is going to be very strongly negative. But the Bloomberg US Financial Conditions Index, everything looks just fine. And summary, this is where I showed you this a few weeks ago. In the background, the US small banks have problems. We're having some problems with First Republic Bank this week. I don't think that's going to be the only one. This year is very much reminding me of 2007. So we'll keep you updated. Next week, we have some important numbers. Inflation watch, Richard.
Thank you, Keith. So this is a chart showing where we are with inflation rates in various economies. So the CPI in March fell in every economy, and core CPI in March rose in US, EU, Germany, fell in Japan, was unchanged in the UK. So UK RPI 13.5%, which is far, far too high. Obviously, interest rates between 3.5% and 4.25% in the EU. UK, Japan still minus 0.1%.
Yeah.
And EU has the transmission protection mechanism to try and stabilize peripheral bonds. And because basically, without that, peripheral bonds would be very expensive, very cheap. In fact, interest rates would be very high. So we have a pretty gloomy inflation summary there.
Yeah.
And so wholesaler profit margins over the past few years have contributed to inflation. And you can see this chart says that without margins, the PPI would only have gone up to about mid 5.5% or so. Whereas with profit margins, it went up to about 8%. So the question is, is the pricing pressure forcing wholesaler profit margins down? And it rather looks as if it is. the global inflation surprise index, which means, of course, not that inflation is falling. It means that people aren't surprised by the inflation numbers.
Yeah, or the forecasts becoming more accurate. I'm surprised by this because everywhere I see, inflation keeps on surprising to the upside.
Yeah, maybe that's what people were expecting and it wasn't a surprise. Are we having first order surprises or second order surprises, Keith?
Yeah.
I'm surprised at the number of people who are surprised.
We should create our own index, Richard.
Yes. Surprisingly surprised index.
Yeah.
US M2 is contracting very fast.
Yeah.
And as we always say, when things change quickly in economies, it's dangerous.
Yes.
And I suspect this is dangerous.
Yeah.
And European energy price inflation is now slightly negative. We've seen what's happened to gas prices. The sort of main contributors to Eurozone inflation now are food, alcohol, and tobacco, out of which I suspect you'll find that food is the biggest, and also non-energy industrial goods pretty high. And services are actually quite high as well, but not energy, and not at the moment. Euro area CPI foods in black, it's high, but the producer price index for nitrogenous fertilizer has dropped right back, which means that one of the major inputs into food price production is falling. I suspect that won't come through until the harvest, this 2023 harvest. Spanish inflation has tended to lead European inflation by 3 months, and Spanish inflation has fallen quite substantially and is well ahead of EU inflation. I can't think why that would be the case, but
no, I can't think why that would be the case either, Richard. But it's an observation.
Yeah,
and, the point is, it's fallen very sharply.
Yeah, and we have European companies are expecting rapidly falling inflation. So that chart is obvious what it's saying. I would just say though that nobody, it's easy. I think it's with modern the ability to do hundreds of thousands of comparisons in a few seconds on these enormous databases. It's actually very easy to pick up correlations, and you don't know which ones are spurious and which ones aren't. And the other point is that had you gone back 19 or 20 months, European companies also expect no inflation would have been the headline.
Yeah.
So I'm always rather cynical about these charts. Businesses are reluctant to give up margins. Of course they are.
Yeah,
absolutely. And there's some evidence that producers have taken advantage of inflation to increase their margins in the UK because presumably it flies under the radar.
Exactly. And this is what Hugh Pill at the Bank of England was talking about this week and getting a load of flack. In that,
how much does he earn actually, just out of curiosity?
160 grand, something, I believe, according to Twitter, who've obviously got hold of his pay slip, or perhaps it's just rampant speculation.
Rampant speculation on Twitter.
Yes. Well, they were right about Fergal Sharkey, so I trust them.
But here we have workers demanding higher wages. Well, we know all about that, of course, because we see it in the UK in spades.
So both companies and workers are trying to protect their livelihoods by raising their prices. In the case of companies, they're raising prices for their goods. Workers are trying to raise the prices for their wages. And until they both stop that, then inflation is going to stay high.
Yeah, the wage price spiral.
Yeah.
JP Morgan are forecast the UK core inflation at 4% by the year end.
The thing is, we cover these forecasts all the time. I would note that last year we expected the line to come down like this. It's just that every month the slope doesn't change. It's just moved forwards a month when it starts.
They never put in their previous forecasts, do they?
No.
All right. So Olivier Blanchard, chief economist at the IMF, and he used to be at the Bank of England, didn't he?
Mm.
Inflation is fundamentally the outcome of the distributional conflict between firms, workers, and taxpayers. It stops only when the various players are forced to accept the outcome.
Yeah.
Well, that's one point of view, isn't it?
Well, I think it's absolutely true. The Hugh Pill's point was that the UK has suffered from this enormous energy price shock, which leaves everyone poorer. And, you can't print energy. So if people try and compensate themselves for the reduction in their lifestyles, all you get is inflation.
Commodity price pressures are currently fading. We need to be aware of that.
Mm.
And the lagged effect that we've commented on before, which can be, I think, several years, particularly with fixed rate loans, will increasingly be felt. We've been saying this for a while. I suspect commodity price pressures will start to rise again.
Really? Oh, God.
But yeah, and the reason I say that is because if we want to move forward to reducing our dependency on carbon, then we need to invest massively in infrastructure.
True. Okay, on to recession watch. So US goods spending has rebounded. So the blue line is US goods spending and is well above its pre-pandemic trend, which is surprising. And you would think unsustainable. But, last couple of months we've seen it bounce back. And recent credit card data suggests that actually in April, consumers in the US have gone out and spent again. But then I just don't see how that is compatible with the Johnson Red Book retail sales, which, reminder, is real data from tills across the country. So lots of contradictory data.
Of course, one of the things about credit card spend is you don't really know what it's being spent on.
True, yeah.
It may be being spent on food, for example, in which case it's simply substituting for wages not being received.
Yeah. US consumers' confidence is very poor, actually. Historically, levels this poor associated with a recession. And on to Richard's point about the Biden administration, so their Inflation Reduction Act has led to a big increase in construction spending on manufacturing, and that's supporting construction demand. But bankruptcies are rising. Small businesses are reporting tightening credit conditions, which is exactly what we would expect. Default rates are low but rising, and coincident and leading indicators are continuing to decline. Notice the coincident indicator is construction and manufacturing, and those are the two sectors we've discussed many times which tend to lead the economy into recession. So the fact that services are doing well, actually that can be irrelevant to recession, because recession starts in the manufacturing and construction sectors, and then as they shed workers, that leads to a fall in demand, which eventually affects the services sector. And Goldman Sachs have stopped increasing their 2023 GDP forecasts, and foreclosures are actually starting to rise in the US, although only 1 in 3,800 homes in the US are in foreclosure, but the rate has been rising quickly. Now, I like this. This is real time economic data from the US, and this is truck tonnage. And you'll see it fell sharply in March. And that shows that the amount of goods being moved around the country fell sharply. Overall, you'll see it's been falling for a few months now. And reminder that houses in the US are at record unaffordability levels. So mortgage payments on the median house just hit a new record high. And that's led to a fall in the order backlog of big US house builders, although the backlog still looks pretty good. Economic surprise index is still positive, but it's falling. Now, this is something new. I wasn't aware of this, but the St. Louis Fed also produces this recession probability model based on economic data. And we've talked many times about how the bond market is forecasting recession in the US. Well, the economic data ain't. There's nothing there. So the US economy is doing just fine, frankly. Although we talked earlier about bankruptcies. If you look at the number of bankruptcies, they are at very high levels. And generally, these levels are only associated with a recession. And you would expect that to be leading to an increase in unemployment. Last week, we showed you the Atlanta Fed GDP now forecast for Q1, and it was coming in at 2.5%. We know now the data was actually 1.1. So again, warnings about the using this data. So in summary, leading indicators continue to predict coming recession. Current data seems just fine, frankly.
So we're looking at the IMF's forecast for long-term interest rates now. So we know that over the past 40 years, central banks have been pursuing this policy of price stability, and real interest rates in all developed countries have been falling. The IMF has looked at the reasons for this fall. What you can see, look at these charts, is a fairly steady decline from about 1982 to 2018, 2019, sort of COVID really, a huge drop off in interest rates with the COVID stimulus, and then interest rates rising back up to that sort of zero line that we've got on the chart. So the IMF concluded that the key drivers of fall in real interest rates over the period were decline in productivity and demographics. So the long-term trend in both of these remain unchanged. So we've got a long-term trend down in productivity and an aging population. So what they're saying is that once the inflationary period has passed, real interest rates are going to resume their downward path. And so the question then is, why would lower productivity cause real interest rates to fall? So I guess you could hypothesize that lower productivity means lower profit margins. Lower profit margins means that enterprise can afford to spend less on interest. So lower interest rates are necessary to fund lower productivity companies. In other words, you get a sort of general deflation of the cost of debt.
Yeah.
And so on that basis, the IMF forecasts that real interest rates in the UK, US, and Germany will revert to their long-term trends over the coming decades. And that real interest rates in China and India are going to fall sharply. So you could see on the left-hand chart, you can see China and India, the real interest rates are, the natural interest rates are high, as opposed to in the UK, United States. I think trying to model interest rates out to 2050 is a fool's errand, personally. I think that I actually think there's a lot of reasons. You know, central banks have been interfering in interest rates significantly for the last 20 years. Governments have tried to stop recessionary cycles, which clean out old companies, and so we have a large number of zombie companies in our economies because interest rates have been so low, and countries haven't been permitted to go into recession effectively by governments. And I think that the IMF's projections are based entirely upon business as usual. I don't think business can carry on as usual, and I don't think it would carry on as usual, even if it could, because I think people are starting to understand that the activities of the central banks have been extremely deleterious to economic stability and financial stability. I hope they are, because that is certainly my view. So I sort of think that the IMF's barking up the wrong tree here. What do you think, Keith?
Well, I agree with the IMF, actually, Richard. I think these remain in place, that these underlying trends remain in place. I completely agree with you that, trying to forecast on this timescale, you're talking, the general trend. Obviously, it's going to be very volatile around this trend. But also, I'd go back to our earlier discussion about, debt sustainability. And the bigger the debt burden, the lower the interest rate, because you just can't afford higher interest rates on enormous debt. And since central banks have instigated this inflation targeting mandate, debts have gone through the roof. And so I just think that we're talking about debt sustainability, then interest rates have to fall if you're going to keep on increasing the debt, and we are.
Yeah. So I think I completely agree with you, Keith. I think if you could take two sides of the argument, one is we have to address this vast sum of debt, and on that basis, I think that will happen. You're saying we can't afford to address a vast amount of debt, and therefore we won't. In which case, you're right. So what rather depends upon the conditions that you set for how you think things will move forward. But I agree with you. So you've heard the two sides of the argument there. My view is that central banks are playing a role they shouldn't be playing, and that anyway.
Well, actually, continuing this discussion, Richard. I mean, the central banks are meant to be a source of stability. They have been a source of idiotic instability over the last couple of years, where they've, QE pumping the economy full of money, and then we've had this enormous inflation surge, which is absolutely the result of all their money printing.
Yeah.
So
I would rather sort of on this debate, I would rather say that the role of the central banks is going to come under increasing scrutiny, and people bemoan the fact that central banks' independence is being threatened by politicians, but actually they've squandered the benefits of their independence. They've behaved appallingly. Their actions have been extraordinarily deleterious for actually the long-term stability of our economies, and I don't think central banks can persist as they are.
Well, on that note, Japan is going to be the poster child for, central bank irresponsibility. Well, let's see what happens there.
Yeah, I would agree, Keith. So it's sort of like, I disagree with the premise that the IMF is capable of predicting interest rates on the basis of the status quo being maintained, because I don't think the status quo will be maintained.
Okay, moving on to stock buybacks. I thought this is really interesting. So let's go back in time to between 2016 and 2018. And Jesse Felder had this piece on the four companies, McDonald's, Caterpillar, Boeing, and 3M, all of which massively outperformed the S&P 500 between 2016 and 2018. And they even outperformed the FANGs. Now, how did they do that when actually their revenues were net declining over the period? And as a result, you'll see their enterprise values to revenues shot up as they increased their debt. So what they were doing was taking on a lot of debt to fund stock buybacks. And these numbers are in millions. So they're spending vast amounts on stock buybacks. And the people who are doing well out of this were the senior executives. And I found these numbers absolutely astonishing. So between those four companies, in the last, 12 years, they've forked out $10 billion to the executive.
Extraordinary.
Absolutely mind-blowing.
So the So the public company system has been hijacked
It has, yeah,
by the senior executives.
exactly. And what they did, so between 2016 and 2018, essentially these executive compensation schemes incentivize the senior management to juice up the share price, but they've left these companies with very high levels of debt, which they now need to refinance. And so since 2018, these companies' share prices have gone absolutely nowhere. I suspect the executive teams have walked off into the sunset with their 10 billion. And now those companies will need to refinance at higher interest rates, and that will cut future profits and presumably lead to the share price stagnating. But the executive have walked off. Thank you very much. So I think that these share-based compensation schemes actually endanger the future viability and health of the company in favor of tempting the executive to indulge in short-term price manipulation schemes. And the board should be stopping them. But I suspect they are also in on the game.
I'm sure you're right, Keith.
On to other charts, Richard.
Thank you, Keith. So Japanese negotiated wage increases are suddenly spiking in 2023 from 2% to nearly 4%. So, as we saw earlier, Japanese interest rates still minus 0.1%. Watch this space.
Yeah.
The poster child for central banking, as Keith brings in.
Well, the thing is, Richard, if interest rates start to rise in Japan, so if the wages rise consistently at, say, 4%, and you have bond yields at 0%, I mean, I just don't understand that how that works. Who will buy them? And if you get interest rates rising in Japan, then the central government could go bust because it's just got so much debt. Any small increase in its net interest rate means that it's fiscally is bankrupt. So
which means there'll have to be a currency reset of some sort. I don't know, but I completely agree, Keith. They're on an unsustainable path. It's just a question of when it breaks. But as we've seen, these things seem to be able to persist for a long, long time in an unstable state.
But let's continue to think about this, Richard. If, let's say, Japan proves, if there's a crisis in Japan, then that will read through to all the economies of the world. Suddenly, fiscal prudence will be seen as very important. Bond yields will rise and governments will have to cut back on their deficits.
Yeah. The world goes into sharp, deep recession.
Yeah.
So this chart shows that Chinese property developers are receiving more funding, but a large chunk of it is coming from deposits from would-be purchasers. And it's quite interesting, really, because it suggests that the Chinese public has still not got enough of investing in property.
Yeah. Well, the thing is, they've kind of part paid for it, so they want it finished.
Yeah, true. Keith is now going to give us some good news, aren't you, Keith?
Yeah. It's only a little bit of good news. So, anyway.
That's good news.
Yeah, this is good news. So, I'm sure you've all seen on Twitter some, these nasty photos of a golden eagle being chopped in half by a wind turbine. I certainly have. Well, it turns out that actually wind turbines are a negligible cause of bird death. Cats are by far and away number one.
I think you need to segment that data, Keith, down into species of bird.
Yeah. Okay. I don't think they've killed many golden eagles. Anyway, bottom line is wind turbines do not kill many birds. They're relatively ecologically friendly, we can say, on that front anyway. Richard, you want to do this?
Yes, thank you, Keith. So moving on to the equity markets for the week. Very quiet week, actually, in the equity markets. Not very much changing at all. And they're all up year on year, apart from the Hang Seng. The topics was up 1%, Bitcoin up 5.6%, pound up a bit against the dollar, and the euro up a bit against the dollar index, actually fairly unchanged, which I don't quite understand since the euro is 50% of the dollar index. And the VIX down 1.3%, so volatility dropping.
Yeah, I have maintained the spread betting thing, so I sold it below 20, and VIX continues to drop. But I'm keeping it on until I get my money back.
Yeah, which you will do at some point. I'm doubtless.
Exactly. Yeah.
So corporate earnings lead revenue. So falling corporate earnings tend to be a harbinger of future falls in corporate revenues. So earnings per share have dropped really quite substantially. So we would expect corporate earnings to fall quite substantially too.
Corporate revenues to fall substantially.
So here we showed all the return of the S&P 500 is from 8 companies, which is what they talk about. There's what's that expression they use? Breadth market, which is where commentators talk about market breadth being very poor.
Yeah, it can't really get much worse than this, frankly. And one of the things that I think is driving the extraordinary resilience of the S&P 500 is speculation about AI. We've got this kind of AI bubble.
Yeah, I think you're right, Keith. It's interesting that politicians have started to latch onto the dangers of AI, isn't it? Rightly so. So researchers at the University of Munster in Germany calculate that day traders who have been buying intraday options may have lost $358,000 a day since May 2022.
Yeah.
Well, who's been making this money?
The investment banks, mate. They write these things, We know that intraday options have been going through the roof. Well, it's extraordinary. Options, very, very difficult to make money on.
I would have thought so. I might have an intraday option on what I have for lunch, but I don't think I'll have it on what the S&P is going to do. So we talked about this just a moment ago. Market breadth is turning down. It's poor market breadth is. The other thing is, it's when you have poor market breadth, it's very misleading. You look at the S&P and you think it's gone up, then hypothetically you look at your portfolio of S&P shares and it's gone down, and the two don't match. So it isn't, and it's not a sign of a healthy economy or a healthy market.
Yeah.
So 18% of S&P 500 companies have now reported, and margins actually have held up well, and earnings per share is down 6.2% year on year. But then we haven't really hit recession yet, have we? Which we are projecting we're going to.
Well, yes, we've been predicting that for a long time, actually, Richard. Well, I have.
One day we'll be right, Keith.
Yeah.
Earnings estimates declining for most small cap US companies.
Yeah, you see, that's it. The companies that are exposed to the real economy are falling quite sharply. It's tech companies.
Yeah.
Their earnings are holding up much better.
So Nvidia is trading at 26 times sales and 160 times earnings, which means it's got a profit margin of 20%, roughly speaking, which isn't bad. But the multiples are extraordinary. And interestingly, a lot of so Google and Microsoft and Apple are all trying to develop or have developed their own AI chips and won't be using Nvidia's graphic chips.
Yeah. I mean, this is just insanity. Who was it? Can you remember after the dot-com boom, there was some executive wrote a piece about, his company had been valued at 10 times sales. Yeah. And we did the piece on this last year, actually. And he was saying, his post-mortem was, what on earth were you thinking? Yeah. And now we're talking about 26 times sales from Nvidia.
Yeah. It's bonkers, isn't it?
And its income's actually been falling.
Yeah. But don't try and short it.
No.
With my advice, US home builders shares also defied gravity. And when Keith and I are right, as we will be one day.
Yeah, fingers crossed.
And there was a little rally and volatility dropped quite substantially. So there's a sort of a disparity, a gearing disparity between volatility and prices at the moment as well.
Yeah.
Whole market is a little bit cockeyed, I think. So this is Bed Bath and Beyond, which used to be one of the poster childs, didn't it? One of the poster children, I should say. And it went bust. It spent more than its entire free cash flow on share buybacks, destroyed its finances in order to push the share price as high as it could.
Yeah.
And you just have to hope. I hope those executives sold their shares before it went bust. I just hope so much that they did.
Well, I'm sure they did, Richard, but they will thank you for your concern.
There we are. So there's the
we were talking earlier about those 4 companies, McDonald's, Boeing. You suspect that they're going to destroy their share price going forward, and the board is really responsible. They should have restrained the executive.
And actually, just a comment on low interest rates. So it's low interest rates that enabled companies to do this. If interest rates were 6%, they would not have been able to do it.
Mm.
So the policies of the central bank have facilitated these sort of financial transactions, which are grossly antithetical, I think, to a successful society and a fair society.
Well, but also, Richard, we're talking about the monetary transmission mechanism. In your point, the lag can be very large. Well, it can be. I mean, as long as their debts are still, charging interest rates of 2%, then they're immune to rising interest rates. But then one day they need to refinance those.
Yeah, and they won't be able to.
Yeah. Okay, on to commodities and energy. So generally a poor week. Brent was down 2.4%, WTI down 2.5%. European natural gas futures continue to drift off. Hurrah! Down another 6% on the week, down 50% on the year. That's great news for us. US natural gas futures appear to have stabilized, up 6% on the week, but still down 50% on the year. Coal continued to fall, down 50% on the year. Uranium had another good week, up 6.5% on the year, and the only energy commodity that's doing well. Some numbers pertaining to the oil market. We had US inventory numbers, and we're still getting draws. So the drawdown from the SPR, the US oil market is undersupplied, and that should support the oil price. US total oil production fell back to 12.2 million barrels a day last week. And the Baker Hughes rig count ticked up by 3, but is down 30 year on year. So the swing producer in the US is not swinging currently. It is not increasing its production. It's forecast to. But also, I would say that we look at the oil price in nominal terms. And actually, let's bring it up. So it's now at $80. And we forget that oil producers, particularly in the shale, their costs are real. And we know that their costs have increased by 20%. So I wonder whether actually a lot of these producers are getting close to profitability, at which point, if the share oil price falls much further, you could see a sharp drop-off in shale production and the market coming quite quickly into balance.
Yeah, good point, Keith.
So this is Chinese oil demand, and the light blue line, it looks like it's fully recovered. Okay, now we're going to quickly go through the OPEC countries' production for period to March. And so this is the OPEC 13. Reminder, they're saying they're going to cut production from May. But so right now it's actually been pretty stable. So Algeria is back on its long-term trend of gentle decline. Angola is actually quite substantial, still 1 million barrels a day, but in terminal decline. Congo, small, stable. Equatorial Guinea, nothing. Gabon, stable actually. Iran, if we believe these numbers, then stable, going nowhere. Iraq actually have been in decline recently. Kuwait, stable. Libya, stable, but going nowhere. Nigeria has had a bounce back. So that's actually been good for OPEC production. Nigeria recovering a bit. Saudi Arabia has cut in compensation. UAE has cut with Saudi. Venezuela have stabilized. So the Biden administration relaxing sanctions on Venezuela have allowed them to stabilize production. Okay, moving on. This is EU natural gas futures, and that's kind of slowly decaying, but still way above the 20 that was the norm pre-pandemic. And this UK natural gas futures, again, drifting slowly lower. All good news. US natural gas prices seem to have found a bottom. Coal is following natural gas. Uranium ticking up again. Richard, industrial commodities.
Thank you, Keith. So some pretty big moves last week in industrial commodities. Aluminium down 3%, cobalt unchanged. So aluminium is actually pretty much unchanged on the year. Copper getting back most of its year-to-date gains, down 2.5%. Chromium down 0.7%. Iron ore down 10%, which is a big drop. Lithium continuing its fairly rapid fall, but again, this is the Chinese lithium price. Neodymium down 6%. Nickel down 3.5%, tin down 5%, ferrovanadium down 7%, zinc down 4%. So big drops in industrial metals, presumably because of demand not growing as fast as markets were expecting it to grow, I guess,
Yeah,
particularly in China.
So this tells me the market is worried about China. They don't think that China's industrial demand is growing as quickly as they had expected.
Yeah. So we have aluminium, cobalt, copper, and Chile is the largest copper producing country by far. 27% of the world copper comes from Chile. And actually, there's some sort of political threat to Chilean production. It's struggling to increase production. In fact, it's the same as it was 18 years ago.
Yeah. So, when we talk about the need to increase production, the world's biggest producer ain't doing so well.
I think if you think that copper is going to be a good investment, you just have to sit in there.
Yeah.
For several years. We have chromium, iron ore. It's actually quite volatile.
Yeah.
Chinese steel prices sliding, which obviously means demand has fallen. There's Chinese lithium. This is Chile has announced plans to nationalize lithium production, which actually isn't really a particularly good sign for Chilean resource stocks generally. Personally, I think South American resource stocks are a somewhat dodgy group, and I would tend to steer clear of them.
Yeah.
Neodymium, nickel, tin, and ferrovanadium. And lastly, zinc. Precious metals, not very much move at all last week in gold and silver. Platinum down 1.5%, rhodium up 12%. Rhodium is very volatile, I've noticed recently. Palladium down 5.5%. So gold and silver pretty much unchanged on the week. The other three, I think, oscillating depending upon what people's view of industrial demand and also what's going on in South Africa at any particular point in time might be. That's gold, silver, platinum, And here we have a little bit on the South African power crisis. Bearing in mind, South Africa produces a lot of the of the platinum group metals. The state producer has this installed capacity of 55 gigawatts. 75% of it is coal. The power stations are old. New power stations were ordered, 9.6 gigawatts, I beg your pardon. They've been plagued by divine forces and construction delays, and nuclear power only produces 1.8 gigawatts, 3%. So Eskom is making modifications to try and extend the life of two of the Coburg units, already behind schedule. And really, South African power is a huge problem, particularly for the natural resources they produce, which are very energy intensive. And it seems to be slipping away from them, doesn't it, Keith?
It does. So medium term, I think the private sector, we go through this, the private sector are coming to the rescue, and there lots of new renewables are going to come on stream. But of course, that takes time. And for the next couple of years, this just looks really bad. So this is, the availability of nuclear power stations. And, you're getting down to like 40%. The whole system is just failing. And they ordered these two new coal-fired power stations, and they're both, either operating below capacity or they've had design failures, chimney collapses. And so the whole system just seems to be falling apart.
Yeah.
And getting worse.
Yeah. And it's sort of the danger is it reaches a point at which it becomes unsustainable, entirely unsustainable.
Yeah. No, that is the danger. If voltage falls below a certain point, then basically the whole grid collapses.
Yeah. And
you see here, the gray line is this year, and the energy availability is just every year it gets worse. But this is the good news in that there are a lot of new licenses being granted, and they are by and large all either solar PV or wind. Now, what happens when the wind doesn't blow and it's a cloudy day? Bottom line is power availability for commodity producers is going to be very poor. And so thank you very much to a viewer, Jeff Prince, for getting in touch and explaining why he thinks that platinum prices have spiked. Basically, there's no production coming out. And that situation is likely to get worse in the short term.
So there's rhodium and palladium. So we may see the price of these go up simply because the South African producers can't produce.
Yeah. Now, the situation in South Africa, Richard, sadly, is I thought very predictable. When you have a one-party state, then they're not held to account.
It's a real shame, isn't it?
And finally, on to rates. Another terrible week, I'm afraid. The bottom line is that the market is concerned about UK inflation, as well it should be, because UK inflation is much higher than everywhere else. And you'll see that the UK yields have been rising, where other countries' yields have been stable. And so we had a rise towards the end of the yield curve this week. And this is the expected path of interest rates currently. So the market is expecting the Fed to raise again at least once, with a small probability of further rises. The Bank of England, the market is expecting 2 more rate rises, and the ECB the same. And hedge funds are big short US treasuries. Now, frankly, I think this is terrible for them. Crowded trades always end in catastrophe for hedge funds. They never learn. And when they all rush to the exit, that means treasury prices will rise and yields will fall. On the other hand, fund managers are overweight bonds, as am I, sadly. We've talked earlier about how the yield curve inversions are forecasting a coming recession. And this is data going back to the mid-60s, which Dario Perkins posted on Twitter. Now, most commentators don't take the data back that far because the data is quite difficult to get hold of. But he's managed to do it. And it shows that actually the yield curve is not infallible. It has predicted most of the recessions, but then back in the early 60s, it got one wrong. Something to be aware of. This is UK 2-year, still rising, not looking good. UK inflation is persistent. Yields are not going to start falling until there's a turn in inflation, a convincing turn in core inflation in the UK. So the 10-year still rising, 30-year back towards its highs. And you'll notice that the US 10-year is well below its recent highs, whereas the UK 10-year is back towards them. The market is concerned about whether UK has got inflation under control. German bund yield, again, well down from its March peak, unlike the UK, Italy, Greece. Any change to your views, Richard?
No change, Keith. How about you?
No change. So concluding comments. Well, a bad week in industrial commodities, actually. Big falls, and that suggests that confidence in the Chinese reopening trade is fading. PMIs for April show service sectors on both sides of the Atlantic doing very well, although there's some contradictory data, and the banking crisis has not gone away. Watch this space. Next week, we have the Bank of England and the FOMC meetings. Richard, how was your week?
I had another very quiet week, Keith. I didn't buy or sell anything. My change for the year isn't really changing. It's around about last week, I think it was 8.5 or so, 7.5. So I'm a little bit ahead of the FTSE All Share. Really, nothing to report. The price of precious metals hasn't moved very much. We've discussed the price of industrial commodities, and I'm just sitting on my hands. So that's it.
Very good.
Doing nothing. How about you, Keith?
Thank you, Richard. Well, it's another poor week for me, down again as bond yields rose. So down relative to the all share and having a bit of a shit year, frankly. But I still expect inflation to come under control and a recession. I sound like a broken record and my timing has been bloody awful, but I'm confident that I will get it all back by the end of the year, he said, yet again.
Quite interesting. In some senses, we have opposing viewpoints, and we can't both. It's unlikely that we'll both be right.
Well, actually, I disagree with that, Richard, because you're long gold. I think gold will do very well.
Do you? Yeah.
Yeah, because the interest rates will come down.
Yeah.
Good for gold. And frankly, we've got so much debt that, you could see central banks will be buying gold rather than US treasuries from now on, and they buy it in size, in tons,
Yes, that's very true, Keith.
This week, in fact, this morning, I finally got round to completely selling out of my PIMCO GBP short maturity UCITS ETF, which did its job in the couple of months I held it, making return of 0.9%. And I put the whole lot into the 2024 index-linked gilts. Now, over that period, you're going to get inflation, tax-free. And so far, RPI just refuses to come down. And there's a 3-month lag in the indexation. So that in the month of May, if you hold TR24, you'll get February's inflation. And in February, RPI returned from memory 1.2%. So just holding it over February gets you 1.2%. And I think holding it between May and June will give you a return of, I believe, 2.1%. So if you hold it to maturity and inflation in the UK continues hot, then you're going to massively beat the return on equivalent bonds. And it's all tax-free. So I put all my cash into that, and that is very much defensive. Once again, I am here stomaching the volatility and believing that my prediction of a recession and a fall in inflation and interest rates will eventually play out. Okay, now talking about stocks, we talked some weeks ago about two UK oil companies with operations in Kurdistan, Genel Energy and Gulf Keystone, and I said that I expected the stoppage of the pipeline to last, and that unfortunately is playing out. So, reminder, exports from the Kurdistan region via Turkey have been closed because the Iraqi government won an injunction against Turkey for breaching a 1973 agreement in which the Iraqi central government had a veto over what oil went through the pipeline. Now, the Kurdistan regional government and the Iraqi central government need to come to an agreement over sharing the revenues for the Iraqi central government to allow exports to continue. And I forecast that I thought those negotiations were going to be difficult because the Iraqi government has every incentive to play hardball. So the arbitration case that the Iraqi central government won against Turkey stated that Turkey had to pay the Iraqi central government 1.5 billion in compensation. Now, what's happened recently is that Turkey are essentially saying they want to talk to Iraq about that. And Turkey has no incentive to allow oil to flow through the pipeline unless they get that penalty waived or they renegotiate the charges for allowing oil to flow through the pipeline. So you can see that this is now three-way negotiations, and they could last for a long time. Now, in the meantime, Genel Energy and GKP have both shut down production, but this could last a long time. Their share prices should be a long way lower than they are now. Now, reminder, I sold back in May last year, and the shares are now down 35%. Frankly, I think it should be half that. And in both cases, they have receivables from the KRG, which I doubt will be paid, at least not anytime soon. Gulf Keystone Petroleum are owed 100 million, and the Kurdistan regional government currently has no income. There's no way they're going to pay that. So you can see these share prices falling a long way. And currently my portfolio is doing not very well. But reminder, I play the cycle, and just showing you two good charts where I sold these oil companies back when they were doing well and they're not doing well, and just looking again at some other companies that I held, I liked, and I sold because I thought the cycle was turning. And Jadestone, which I fully intend to buy again, it's down 49%. And so, although I've timed my entry into the new trade very badly, timing my exit from the old trade, I think, has done pretty well, actually. And if I'd held on to some of these, I would have been murdered. This is Independent Oil and Gas, and which is a developer of natural gas assets in the southern North Sea. And I sold when the share price was drifting off. I didn't get a great price, actually, 25.5p. But since then, it's had some difficulties with its wells, which have been disappointing. Share price now 4.6p. You don't need many of those to totally destroy your portfolio, frankly. And the bottom line is you buy oil companies when the oil price is rising. When the oil price is falling, get out. So that's it. Another difficult week for my portfolio, but we're expecting at some stage very rapidly rising interest rates to start having an effect on inflation and the economy. So next week, we've got the FOMC meeting, the Bank of England meeting, and we'll know how much money's flowed out of the US banking system. But have a good week. Thank you all for watching. please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye for Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.